Welcome back to another quick stock analysis. Today I'll be looking at GEO Group.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul. Today I'm looking at GEO Group by popular request from Geraint M. Now GEO Group has had a very long history of trading at an average of 15 PE, and every time things have got very exciting, the price has hiked way above it. But every time things get a bit scary, the price goes way under. This is just how average PEs work. And right now, Geraint is pointing out that this company has been on a heavy drop for quite some time now. The last time you would have bought GEO Group would have been in 2004, 2005, this price. And if you'd held it all the way through these great times of GEO Group, you would now only be on an 8.5% annualized return, which isn't bad. That's market beating, to be honest with you. But it would be a real shame if you were sitting there with GEO Group right now, because if I sold out at the highest point right here, you're looking at a 500, 600% return. Yeah, it's unlucky if you've been holding on. But right now, Geraint wants to know if this is undervalued right now. Now, GEO Group is a REIT, but it's a REIT which invests in prisons and rehabilitation facilities. So this is an interesting one to get into. Now, just a reminder that what I look for in these quick stock analysis is the top line revenue growth. I want to know that their product and their revenue is growing all the time, that people want to buy it. I usually look at EBITDA, but when this is a REIT, EBITDA probably isn't going to be the best measure of this, because basically REITs have to give out 90% of their earnings as dividends. So EBITDA might not be the best reading for this company. Then I want to look at justifiable debt. Then I want to look at cash. Cash is the most important thing to a business. I want to know if this company is generating good free cash flow. If it is, we will then know if this company is very good at giving back to its shareholders. Then I want to try and look at some analyst forecasts, and then I finally want to look at and see if this company is within value right now. So GEO Group has had negative 78% growth in the past 2021, 4 years, 4 years. In fact, looking at this company, because it's never paid a dividend out before, I wonder if it's only just become a REIT. That'd be interesting to find out. I just want to have a quick look at that. So there you go. So it only became a REIT in 2013. That's very interesting. And it looks like, yeah, in 2012, there we go. There's the first dividend payment in 2013. So, yep, it had to start paying its dividend in 2013 because it became a REIT. Becoming a REIT gives it a lot of favorable tax advantages. So this might have been one way GEO Group wanted to go. Still doesn't explain why the market has decided to value GEO Group so unfavorably since 2017. I'd like to say it's because it's been growing its dividend now for the past 4 or 5 years, and this year in 2020 is the first time the actual dividend payment has gone down. That's very interesting right there. It was flat in 2017 to 2018. 2019 went up, and now it's back below 2017 levels already. Very interesting. Okay, so let's take a look at the nitty gritties of GEO Group, and we have a lot of issuing shares since way before 2013. In fact, to my surprise, because it's quite normal for a company, a REIT, to issue shares. It's one of the ways that they make money. REITs have to consistently keep buying new properties, and those are expensive, a lot more expensive than the rent they get from the properties that they either lease out or that they own. So one of the big ways that REITs make money is by issuing shares. And to be fair, it hasn't issued that many shares since it became a REIT. I don't look at share issuing a lot. I know I should, but it's interesting that they've slowed down their share issuing. Okay, so let's look at revenue. And over the past 10 years, it looks like the revenue has been growing for GEO Group. 6.3%, not a lot, but that's not bad for a REIT at all. Reducing it down to 5 years, we still are maintaining that revenue growth, which is quite good. It shows that the product that they're using is quite popular. This company, remember, it owns a lot of prisons and it runs a lot of rehabilitation centers. It's just had this reduction in revenue in 2020. I imagine they're going to blame that on COVID. I'm going to skip EBITDA growth because that doesn't really matter for a REIT. And we're going to go straight to debt. Okay, so total debt is going up quite considerably. 10 years, yep. Definitely has been going up. Again, this isn't necessarily a bad thing for a REIT because this is how REITs make their reinvestment. And a lot of this debt is also collateralized against their properties. They don't necessarily have to have the cash on hand to pay for this debt. So within REITs, sometimes the balance sheets can look a bit fuzzy when measuring the debt against its cash because unfortunately, the debt is collateralized. Again, I'll say the same thing. It's the debt is put up against their buildings. So if they can't pay their debt, the banks will just take away some of the land or take away some of the buildings. That's kind of how it works for REITs. But free cash flow for any business is the most important thing. We need to know that this company is generating cash and it's got enough cash to pay its dividend. And over time, over the past 10 years, it has been a bit choppy, but in general, it is going up. And in fact, considering 2020 had quite poor revenue growth, this 2020 free cash flow growth is very good. It's very high. Let's drop it down to 5 years and we're still getting the upward trend. It's saying here a cash flow growth of 138%. That's quite high and probably a bit too much for a REIT. It'd be interesting to see what they think their forward guidance is for next year. I imagine it's going to be a lot lower, but just a quick valuation on it: 125, 110, 233, 79, 221, 331. It's about 150. So if we do 150 times 15 price to cash flow ratio, 2.2 billion. So that's what we could be thinking that GEO Group could be worth, 2.2 billion, and the market cap right now is at 917 million, which suggests that GEO Group could be quite undervalued right now. Let's take a look at what FastGraphs thinks though. And what's awesome about FastGraphs for me for valuing REITs is that it has a straight free cash flow price to AFO ratio right here. So let me just add all of these things back on. And what we are seeing right now with GEO Group is that this stock could be very undervalued. FastGraphs has a price to AFO ratio of 3.1. That would make it, wow, that would make it really undervalued in comparison to what I thought. And GEO Group's normal price to AFO ratio looks like it's 8.8. So historically, GEO Group has always traded at 8.8 price to AFO, and that's very important to remember that we might not be considering this growth rate of 12.8 price to AFO. Remember, this orange line is what the price to AFO would be, price to adjusted funds from operations. This is what the price would be if GEO Group was to trade at a price to AFO of 12.8. The price that GEO Group could be right now if it traded at a 12, 13 PE would be $32. And I think that would be a market cap of that would be a market cap of about 2 billion, wouldn't it? But looking at this since 2013, where this stock has been trading, it's actually been on a downward slope since it became a REIT. That's very interesting to think about because it never really, things got a bit excitable here between 2017 and 2013, and that was great, 20% year on year nearly. But in general, from its inception as a REIT, you would be losing 1% a year on GEO Group right now. So this is something to think about. We need to think about where this company is valued and why, as part of after this, once we do value it, because I think we are going to see that GEO Group is significantly undervalued. After this, it would be a really good idea to go out and figure out why the market is valuing this company so negatively. There must be a reason. I mean, prisons aren't popular right now. They wouldn't go very well with your ESG. Prisons do, however, always need to be around, and I kind of get that. It just depends how much more expensive they're becoming, I suppose. It might be something to think about. And in general, I don't think there's a positive vibe around prisons in general. I mean, there isn't normally, but right now, especially in the recent years, I've seen a lot of documentaries personally on prisons and how their business model is basically to keep you there. It would make sense from a business point of view to keep people reoffending and to keep people coming back to prison all the time, because then they get more money from it. So I do kind of understand why this is a bit of a dodgy business to be in prisons right now. And it's in prisons all around the world. I think it was Australia, South Africa, Central Africa as well. There's got to be some dodgy stuff going on in there. 75% long-term debt to capital is not bad for a REIT. In fact, that would be normal. And just quickly having a look at their dividend payments right now, it looks like their dividend payout ratio is 70%. And that is totally normal for a company that is classed as a REIT. There's no issues from that. And you can see that it's pretty consistent with its cash flow as well. And this company drops its dividend whenever its cash flow goes. So you can expect, and this might be why the company is being undervalued right now. If this always trades, it generally trades at around 69-70%. Yeah, always around 69-70% of its price to AFO. So if it always trades 69 to 70% of its AFO, you can expect that if it is having a lower AFO next year, if it is having a lot less cash coming in next year, then you can expect that this dividend payout will actually be down here somewhere. So you could see, I don't think I can do any calculation there, but you could see another drop in its dividend next year before it starts to recover the year after. So this might be a case of timing the value and seeing where the dividend is placed next year. If this company keeps its dividend straight, you might see a change in this share price, right? Okay, quick forecast, because this is what we're seeing right now. If GEO Group did grow again at an average of 10% over the next 6 years, and remember, we're picking 10% here because actually the revenue growth hasn't been bad, and the free cash flow growth up to 2020 was very good. So it is possible, according to the math. It just shows that it's got a 10% year-on-year growth rate. That's very good. I'd say that's a little bit too much for this REIT, to be honest with you. But let's say that it goes back. I'm going to do this on the custom calculator, actually. And I'm not going to give it 10%. I'm going to give it, let's go 8%, just because we're trying to find the worst situation here. So we give it 8%, and this company usually trades at a PE of 8, price to AFO of 8.8. So GEO Group normally trades at a multiple of 8.8. And this is the terminal multiple. So this is, in my view, this is how popular this stock is going to be by 2026. This is what you're trying to guess. You're trying to guess how popular this stock is going to be, or this sector is going to be by 2026. Because what you're trying to think is what price the market is going to pay for this company in 2026. For example, tech stocks. Everybody loves tech stocks, so they start trading them at ridiculous multiples. Tesla 1,200. You've probably got Apple at a PE of 60, something like that right now. Tech stocks or high growth innovation stocks, they usually trade at around a 30 PE. A normal slow growth company usually trades at around 15 PE, 20 if it's quite a good one. So this company, because it doesn't get a lot of love, you can say that it might trade between 8 and 12. And that's what we're going to use here. I'm also going to be very cautious on its growth and say that it's only going to grow its free cash flow and its AFO by 8% year on year. And right now, the price is currently $7.56, and that's at a market cap of about 917 million, which is good. And it's trading at a price to AFO of 2.97. That means, in its worst case scenario, if GEO Group doesn't move at all and still grows 8% year on year, you will receive a total annualized return of 23.29%. And I would say that that's likely to be quite a bad case scenario. In fact, let's just really make it bad, and we'll say it's only going to grow 1% over the next 6 years. If GEO Group only grows at 1%, and I think that is being really harsh on GEO Group, to be honest with you. If it only grows 1% over the next 6 years, you will still have a total annualized return, because of that massive dividend, of 16.88%. This does mean that it needs to include its dividend right now, though. And I'm trying to find you the worst possible case scenario. And that's pretty good, to be honest. And let's say the market decides that even though it's got its 1% year-on-year growth, let's say the market decides that prisons aren't so bad, GEO Group's not so bad anymore, and it decides to just trade back at its normal PE of 8.8. You potentially, from a value investing point of view, you potentially have a total annual return of 30%. This is tech stock level returns right now. Obviously, there's something that the market doesn't enjoy. Let's just make it 5%. I'm just going to make it 5% year-on-year growth, just to be nice. Like to really find, and I'm really trying to find the best case scenario here. So if I give it a 5% growth rate over the next 6 years, and then let's say it gets really popular and goes back to a normal stock. In fact, I'm not going to give it a normal stock because it's never traded at a normal price to AFO. At its highest, it's traded at a 12 price to AFO. Well, then in 6 years, you could see a 40% increase year on year for GEO Group. And that is an incredible return right there. And let's not forget, the GEO Group has actually produced this return before. It has, since its inception in 2020, no, it's 2004, wasn't it? 2004 was when it was really low. And then all you had to do was wait till 2016 and you were on a 600% growth. So GEO Group has done this before. This is not like it's new to GEO Group. This is not like it's never been like this before. Very interesting company that I've been sent here. And with the best case scenario, 6 years, you're looking at 600%. Worst ever possible case scenario, worst, I think, because I still don't think this company is going into negative growth anytime soon. It doesn't look like it. The revenue doesn't seem to be doing anything bad. It looks like it can pay off its debts. These would be things that you need to look at much more heavily in like its 10Ks, and you've got to look at it from a qualitative point of view. But this would be a company that sets me off to go, oh, actually, this company might not be so bad. Because in the worst case scenario, this company doesn't go anywhere. You've got a 13% dividend yield. Fair enough. That dividend yield is not safe. That's definitely something to think about with GEO Group. And thank you, Geraint, for bringing this one up, because this one's interesting. I'd like to know more about this company. I'd like to know more about where this REIT is going. Thank you very much for watching, guys. I hope you found this one interesting, because this has really shown that there is some value out there that we might not be noticing. As ever, I'm not sponsored by Fastgraphs. I just find it a very interesting and useful tool. I pay a full subscription to it. However, I do invest with Trading 212, and if you wanted to sign up to Trading 212 to start an investment account, you can sign up through a link in the description below. If you sign up through that link, you can get a free share that's worth up to £100, and I also get a free share as well. I also use eToro to buy Bitcoin, but you can buy lots of stuff on eToro as well. If you wanted to sign up to eToro, which I find is quite a good platform as well, you don't get anything for that, but you really do help out the channel by using the affiliate link. Thank you very much for watching, guys, and if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.